Ooh, have you ever checked your investment portfolio after a market crash or a correction? Hasn't everybody? But should you? Is it a time for panic or a time to prosper? Today, we break down what a market crash, correction, and a bear market is and how we can navigate it. Let's chop. If the stock market was a roller coaster, then stock market crashes and corrections would be drops and dips rather than just total derailments. What can we do during corrections, crashes, and bear markets? And what are they? Today, we're going to break that down and see how we can navigate our emotions and our actions during this time. Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth Management, where we help you align your life and money so you can apply those to your financial strategies to live your life your way. And if you like what you see, hear, and feel on the show, then go ahead and hit that like and subscribe button and share with your family, friends, and colleagues. All right, let's chop. There's a lot of volatility that's happening currently. And you know what? Volatility happens in the markets quite regularly. That said, we don't have to panic during those times. Now, we're going to discuss the different market environments and how to navigate it and how to better understand. Now, we don't know your investment situation or your whole financial planning situation. Every household is unique. So we cannot guarantee future returns or tell you what to do. This show is just passing along information to see how to better navigate and control emotions and give some insights on how to better just walk the path of investing when you're talking about long and near and long-term goals that you have. So when we're talking about volatility, it doesn't feel very good, does it? Folks, start checking those retirement accounts or those brokerage accounts and saying, well, I got to do something. With this correction or this crash or whatever it may be, right? Then I got to do something. And sometimes doing nothing is something, because sometimes making a rash decision can affect a long-term return on your portfolio over 10, 15, 20 years. And we'll talk about why that is. Also, there's some times where you can make little shifts, right? Like you saw me on my chair here. For those that are watching, I did a little shift to get my back straight a little bit. But I didn't just run out of the chair, right? So that would have been a panic in action. That said, when volatility is happening in the markets, we have to affirm how everyone feels. And it is okay to feel volatility. We're talking about people's lives here. So we can't discount how people feel during these times, because they're building wealth. You're building wealth. You are using your wealth to fund your lifestyle now and your retirement future, and even living during retirement. So it is okay to have these feelings. Now it's about having the tools of understanding and insights to better navigate and swim the waters. So let's break this down. What is a market correction? And what is a market crash? What is a bear market? Corrections are 10% movements downward off of recent highs. Crashes are 20% movements downward off of recent highs, and they are more elongated. And minor shifts in the stock market, like drawdowns, those are about 5%. And so you have crashes that are really sharp, and everybody knows it. You're talking about COVID, you're talking about financial crisis, of course, the 1929 stock market crash. So those stock market events that are drastic and very quick and sudden, large drawdowns from highs, 20% or more, and everybody feels that. There's more than likely something going on in the economy that causes that that sharp that sharp dramatic volatility. Like I said, COVID and the financial crisis. Now corrections, those are 10% off of highs, and they actually happen more frequently than you think. Corrections and slight pullbacks of 5%, they are quite healthy for the market. I mean, it flushes a lot of maybe run ups in the market or overheating in the market, and it corrects them into a way to where it just doesn't have false gains built up in the market. And what happens is information is ebbing and flowing through the markets all the time. The market prices information. So sometimes there's going to be a triggering event or a cluster of information to say, and the meaning the markets are going to say, because they talk to where they're going to say, yeah, there needs to be a pullback happen here. And a pullback is 5%, and then perhaps a correction of 10%. And hopefully the economy, and they do happen because the significant events that cause crashes do happen. But corrections, they tend to have recovering periods directly thereafter. How often do corrections happen? Well, typically they happen every 1 to 2 years. There was not a correction in 2024, and there were 50 market highs during 2024. At the beginning of this year, at the taping of this show, is 2025. And then we started out the year with a correction of 10% off of highs and more. All right. So that kind of makes sense. Every 1 to 2 years, there's a 10% correction. We cannot time it. I want to make this clear that nobody can time the market, or everybody would be beyond wealthy, right? Everybody would have billions of dollars if everybody knew how to time the market. It's timing the market, not time in. And I know that may sound cliche, but I want to stress with you. If everybody knew, then we could time it all day, right? But we can't. So when you talk about corrections happening every 1 or 2 years, they tend to last about 4 months. And then some recovery period comes thereafter. And these are just historical numbers. That doesn't mean it's going to happen every time. That said, it kind of demonstrates, well, if a correction is looming or happening, is it going to be for an elongated period of time, such as a bear market? Bear markets last, months and months and months, and then they're going to need months and months and months to recover. Whereas corrections and slight pullbacks of 5%, that may not be a reason to panic and have mass selling out of the market, right? And when we talk about the bear markets, and they talking about months and months and months, you're talking about 9, 10, 12, 18 months perhaps for bear markets. And remember, a bear market are elongated times of 20% drawdowns out of highs because of multiple things that are happening in the economy. So one of the things that you want to be mindful of, as far as perhaps staying invested during pullback or correction times, is there's a nice piece of analysis that over the 20-year period of 2002 to 2022, there were 10 best days during that decade. And if you missed the 10 best days, then your returns during that year fell from, say, 9.8 to about 5.5. And there's always best days and worst days within intra-year, not just over a decade. So after corrections and pullbacks, right, those 10% slides and those 5% slides, there tends to be, those are some of the worst days. They don't feel good, right? But right after that, there tends to be good correction days upwards and recoveries. So 10 best days, 10 worst days. Now, if you start missing those 10 best days because of panic selling, then you haven't given your portfolio a chance to experience those recoveries on your portfolio. So staying invested long term and capturing the 10 best days intra-year and over decades can help your portfolio significantly. Again, not telling you what to do because we don't know where you are in your life cycle or your risk profile or or your situation. But knowing that there are 10 best days and worst days, and historically missing those best days by exiting quickly can bring some harm to your overall long-term investing. All right. Well, how how do we recognize, you think? How do you recognize a market downturn? Do we know that it's coming? Well, again, we can't predict the markets. That said, there's some signaling that tends to occur to help you warm you up a little bit, right? And when you're talking about market corrections, those 10% drawdowns and slight pullbacks of 5%, well, it's common news. So interest rates, inflation, those are two popular ones, right? Unemployment, companies not meeting their profit goals, the revenue goals. So all their reporting it comes up short, right? So if you have a culmination of these areas and information is coming in, then the market's going to time that in and see if it's too rich or not, right? Meaning running hot. So the market it will say, well, I'm going to cool myself down by pulling back perhaps 5%, 10% or more, right? And it's all a culmination of that information. That said, when you talk about bear markets, right? Bear markets are recessions. They are caused or influenced by like geopolitical risk, wars, overvaluation in the stock market. And those are going to cause elongated periods of downturns in the market, and then hopefully a subsequent recovery afterwards. But they are longer than, when you talk about bear markets and bear market signals, they are longer than a correction or a pullback. Now, there has been, after every, let's take example for a bear market. Since 1929, there has been, 28 bear markets, 26 bear markets, and 27 bull markets, right? And bear markets tend to last a little shorter than bulls. So when you talk about bear market time and how long bear markets last, well, bear markets last about 289 months on average, whereas bulls average about 900 plus 940, 950 months on average. So when we have a bear market, historically, it still feels not good, particularly for 9 to 10, 12, 18 months. But then the bull markets last historically 2 or 3 times that long, right? Sometimes 4 or 5 times that long, right? So that's when you're talking about having those best recovery periods and missing them. So if you're not invested in the market during the time after a bear market, oh, wow. And those sharp recoveries tend to be more sharp upwards than they are sharp downwards over time. And if you think about the 2008 crisis with the financial crisis, and then COVID, look at the chart, right? Yes, you have a crash down far as market crashes and bear markets, but then the sharp turn up is double the length of the turn down on a graph. So that gives you some encouragement to hopefully have, and that's why we had a show about emergency funds, and it's very fundamental to protecting you from making rash decisions during times of crashes, and maybe some opportunity times during corrections or pullback. So when everybody likes to be shopping on sale, right? We have Black Friday, we have the holidays, and all of these different shopping sales, right? And when we go to Costco and see the little star, the little asterisk on the side, everything's on sale, right? Well, how about taking advantage of that opportunity in the market when things are on sale, right? Going into the market and seeing your best ideas to you, whatever what they are, what you've been keeping an eye on, or what your financial advisor has been keeping an eye on, and picking some of that up, right? Shout out to my sister, because sometimes when she sees the little end caps in the stores with the discount racks, she'll buy 6 or 7 toothpaste or whatever's on that end rack, right? in order to, because everything is on sale, and she's stockpiling on that, right? So it's an opportunity for things that are going on sale in the stock market to stockpile a little bit, to pass your end caps and buy some of that stuff, y'all, right? So you want to avoid panic selling during corrections and crashes. You want to avoid the behavioral finance of herd selling, following the herd. And perhaps if you want to do something, to do something like tactical tilts, which is an example of if you have an allocation of 80-20, 80 in the equity and 20 in bond-like areas, then perhaps you shift to 70-30 or 60-40. That's something that could be considered. Again, we're not telling you what to do, just throwing some information out there for your consideration so you'd be less inclined to panic and then prosper over time. Also, dollar cost averaging is the key here, because if you continue a investing schedule month after month, or check after check, and you're automating your finances to go into a retirement account or a brokerage account, then you are automatically buying stocks on sale. So you could set that, forget it, remember, automate, and you're buying prices at different levels throughout your investing life cycle. So you're already buying stuff on sale. DCA, dollar cost averaging, is a positive thing. Now, lastly, what do you not want to do, right? What do you do during market corrections? I've already given you some insights to consider, but there are some things that says, what do we do during corrections during time like these? Because 10% sometimes doesn't feel good. So what should you do? Well, here's what you don't do. Just sell everything. All right. During market corrections and pullbacks, it's not optimal, right? During markets corrections and pullbacks, it's not optimal to just sell everything. That is outright panic. And over the long term, historically, that just simply hasn't been something to do. Now, also, too, here's some more extremes. Going all cash. Because if you go all cash, then there's some bed bugs, right? Nobody likes bed bugs. They itch. So what is the itch? It's inflation. And inflation is going to eat up all your money if it's all in cash. So selling everything and going in cash. Also, too, just following trends. There's a whole bunch out there for stories, and you'll come off some sort of information that tells you to buy the next thing or invest in this hot stock, that's not that's not your goal or your agenda. So avoid those areas. A couple of things to be considered is portfolio rebalancing during pullbacks, corrections in particular, and bear markets. You could do some portfolio wrangling a little bit to reposition it, and also too, like I said, buying stocks at a discount either through dollar cost averaging or having some cash on the sideline in a core and satellite portfolio approach. We'll have a whole show on core and satellite and how that strategy can help you have some cash on hand to buy things on discount. Again, all these are insights to consider, not advice, but considering and having more information helps all around. All right. So you have more information about crashes, corrections, and bear markets, right? So with more information and knowing what the environments are, you can better navigate them either yourself or with your financial advisor that knows your long-term aspirations and your immediate needs in order to be flexible enough to meet those as well. All right, that's what I got for you. If you like what you see, hear, and feel on this show, please hit that like and subscribe button. Until next time, we'll chop soon. Cheers.
Free audio post-production by alphonic.com.